And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning and welcome to the show. It's Repeat Monday. So here we go again. It is back to Monday, of course. It is a repeat. We do Monday every Monday, but this is especially an important Monday because it's the same as last Monday. I get in here to come do the show. I've already got my topic set up. We've already tweeted our topic out. We're going to talk about market cap and why that's a very important thing to understand as it relates to, well, the economy and to your money. But before I do the show, we have another vaccine announcement this morning as Moderna has now come out. Now, last Monday, Pfizer announced a vaccine that was 90% effective, right? And of course, that's caused this big spike in the market. We wound up selling most of it off during the day as traders, got in and got back out again. Well, this morning, we're going to be up sharply once again. The Dow is expected to be up about 500 points here at the open. And this is because Moderna has now announced a new vaccine that is 94.5% effective. So take that, Pfizer! And like Pfizer, they expect to have 20 million doses by the end of the year, and 500 million doses to 1 billion doses in 2021. So the vaccines are now coming fast and furious now that the election's over.
Oh, wait.
Just saying. But anyway, this of course is the real issue, right? So, and now what you're seeing is, of course, is that, it's this idea that, we need to buy all these companies in the market that will benefit from a vaccine. The problem is that, a lot of these companies, aren't really that undervalued to start with. And, if we take a look at the number of companies with negative equity, we take the number of companies that are heavily burdened with debt, valuations really aren't cheap in a lot of areas of the market that may be considered value. More importantly, while a vaccine is important, and there's certainly, I'm not putting anything past the vaccine, it doesn't mean that we're about to get back to uber strong economic growth, because we didn't have uber strong economic growth before the vaccine, which is the more important thing here. Now, during this process, we've ramped up our debts by about $3 trillion. We're running a $3 trillion deficit. That will impede economic growth. But yes, if we do get a vaccine, very important here, we will get people back to work. Theoretically, we'll get them out of their houses, back on the street, consuming things. So we'll certainly see an economic uptick once you start getting a vaccine into the market. But again, you're not going to heal everybody tomorrow. And not everybody's going to go back to work the day after tomorrow. This is going to take a year or so to get rolled out. Now, the market's going to front run this, of course, and because the markets are anticipatory. But the markets are already extremely overvalued, even at this point. So the problem for the markets are going to be going forward is yes, you're going to get economic growth out of this, slow and steady. But we're going to get back to a slower rate of economic growth than we were previously. So, and this is one thing that, as we talked about in today's report that's on the website, talking about the market cap to GDP, if you take a look at the stock market relative to the economy, it's grossly overvalued. And the importance about that is that while the stock market itself isn't today a direct reflection of the economy, yes, they can certainly separate from each other. Long term, there is a very high correlation between corporate profitability and the economy. Now, that makes complete sense because, well, the economy, what you do, right, what you go out and buy and sell and do in the economy is where their corporate profits and revenue come from. So you now have stocks that are grossly detached currently from both corporate profitability and the economy. And while a vaccine will certainly get people back to work in the economy, it doesn't mean the economy will catch up with that valuation longer term. So eventually, the problem here is for this whole idea of a market surge based on economic recovery based on a vaccine is that it's already primarily all priced in. There's a few pockets of the market that have underperformed this year, and we're likely to see a bit of catch up in that area. But again, what you need, for instance, for example, for financials to have a strong economic recovery and a strong recovery in their sector, they need higher interest rates. Well, the problem is interest rates can't go up, because if you get higher interest rates, you're going to immediately slow the economy, because we've got $75 trillion worth of debt. So the problem for financials is they need higher rates, but you can't get higher rates because the Fed won't raise rates, and the Fed's going to make sure they suppress interest rates through their actions to make sure that the economy continues to work. And that economy, because there's so much debt, requires much lower rates. Energy companies, another good example here, they need more economic activity, right? They need economic activity that starts to create a demand surge that is going to lift oil prices. Well, I've been writing about now for 3 years about the problem of the global demand side of this relative to the supply side, and why oil prices were going to remain low. And nobody believed me 3 years ago when I wrote that article, but here we are, still with low oil prices because of that demand problem. We're not going to get back to the same level of demand, even with a vaccine, that we were prior to the pandemic. So energy companies have a problem going forward as well. And we haven't cut enough production yet to really bring that back in line with what's going on with global demand. So, and now more importantly, as we get this vaccine, it's going to take a long time to get that out. There's problems with that, in the foremost places. We talked about with Pfizer last week. Their issue is they require negative 94 degrees. So a freezer problem for a lot of small rural counties and basically third world countries are going to be a problem for the delivery of the vaccine. So this is going to take a while to get the global world back up on its feet. We'll see the same problems here. We still got it. These are phase 3 trial drugs. They've got to go into phase 4. They've got to go into human testing. This is going to take a while. We're probably not going to see a vaccine actually hit the markets on a wide basis. And when they're talking about these early doses, those are going to the phase 4 trial recipients after FDA approval. And then, of course, they'll get that to emergency personnel, people that are desperate for it, people in hospitals, in life support, those type of things. They'll certainly get treated early. But for the likelihood of you seeing it down at CVS or at Walgreens, that's probably not going to happen until mid-2021 at the earliest. So there's a lot of things that have to happen here. So again, all I'm cautioning you here is with markets already extremely overbought. We wrote about that in this weekend's newsletter. With markets already extremely overbought, extended, very bullish here, this is typically a time that you want to start taking some money off the table rather than jumping into the market. So again, be a little bit careful where you are within your portfolio, how much risk you're taking. Again, everything's positive and bullish at the moment. And again, we've been talking about this for a while, that when we look at our money flow indicators and our buy signals, those are all back on positives. That's been a good buying opportunity here. We've had a nice rally coming off those lows back in October. But again, we're getting to the further extent of that rally here in terms of being overbought, overly bullish, extended from long-term means. All those things are back into flavor here to where we've seen previous corrections in the markets previously. But just watch this money flow indicator. When it begins to roll over, that will be your indication to start, getting more out of the markets. Now, when will that happen? That's likely going to be in the first couple of weeks of December, right after Thanksgiving. Mutual funds start to go into their distribution phase to distribute their capital gains and interest income for the year. And with mutual funds running very, very low cash levels, they're going to have to sell stuff in order to make those distributions. So again, there's a lot of things kind of lining up here for a correction here over the next couple of weeks. So again, be careful taking too much risk in your portfolio. You'll have a better opportunity to put money to work, but just be patient. Let the market come back to you rather than chasing markets. You're not going to miss anything here. Plenty of opportunity and time to put money to work. Take a quick break. We'll come back. We'll get into a little bit more about market cap, GDP, why it's important. I'm your host, Lance Roberts, for the Real Investment Show. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Long-term care is the financial elephant in the room. The median national cost of a private room in a nursing home, $8,517 a month. Are your finances prepared to handle that burden? Our next Candid Coffee with Richard Rosso and Danny Ratliff can show you how to protect your finances from the effects of a long-term care event, the myths to ignore, and how to prepare a plan to address the cost. Register for the special long-term care edition of Candid Coffee, Saturday, December 5th at riaadvisors.com.
You're listening to The Real Investment Show.
Welcome back to the show this morning. It's 6:17 on this Monday. So, of course, this morning the big news, of course, is that Moderna vaccine is 94.5% effective. Take that, Pfizer, who's only 90% effective. Who wants a 90% effective drug when you have 94.5%?
I mean, really.
If, I just want to know who's coming out next and say mine's 94.75% effective. There!
Drug marketing wars.
I have a vaccine that's 100% effective. Just stay away from everybody. It's called Recluse. Get it today. It's 100% effective, and it doesn't cost you a penny. Anyway, I jest. But anyway, so this is the good news this morning, of course, and again, this is going to provide another short-term boost to these, kind of the hopeful recipients of this, right? Airlines, cruise ships, this type of thing. Because again, if people are, this is kind of a repeat of the show from last Monday, which is once you get confidence back in people, theoretically, they're going to start, going out to travel and do things again, right? Well, the problem is more than just that. I mean, yes, that's a very important factor for cruise ships and airlines and hotels and all those type of things. But again, there's also a timing issue of all this. I mean, as we talk about this vaccine coming to market right now, we're also talking about Michigan, as an example, is shutting down their state again. And this is something that's likely going to occur throughout the country here as we begin to shut the economy down again. This is going to impede growth upon a lot of these companies. So, trying to buy these companies now may be a bit premature because, and I'm not saying that there's not certainly a tradable opportunity here. There certainly is. But if you're thinking about, I'm going to buy airlines now and I'm going to hold them, that may be a bit premature because, again, for a vaccine to get to market and to get people back to a comfort level of, wanting to travel, get on airplanes, those type of things, it's going to take months, right? I mean, we might not even see a vaccine widely available until sometime mid next year. So, and again, that's all good stuff. Don't get me wrong. But in the meantime, we've got a lot of economic problems. And more importantly, is the economy will be different coming out of this vaccine than it was going into it. People have changed behaviors. There's a lot of people that are out of the labor force that weren't before. If you take a look at the number of people that are no longer as part of the labor force, that number has surged. Labor force participation rates are now at a lower level than they were previously. And this is an important point because after the dot-com crisis back in 1999, the labor force participation rate, the number of people in the population participating in the labor force fell. And we made excuses for that. We said, well, the reason is that, baby boomers are getting older and they're retiring. And, technology is displacing some workers, so that makes some sense. And people are just opting to stay at home. Right? Easy excuses, right? Easy excuses. And the problem, though, is that even though as the economy recovered, the labor force participation rate never actually did. It actually kept declining. And then the financial crisis came along. And the labor force participation rate declined again. And we were somewhere around about 63% of the economy actually participating in the labor force. And we said, well, that's because baby boomers are retiring and because of people just deciding to stay at home, those type of things. And so we made more excuses. And a decade later, even after, $30 trillion worth of government interventions and Fed interventions into the economy, so forth and so on, that labor force participation rate never improved very much. So basically all the economy did for the most part was just absorb new growth rates in the population. Well, now, because of what's happened with the pandemic, we're no longer at 63%. We're at about 50% in terms of the labor force participation rate. So we've had this big slide, and yes, we're going to recover that number some. But very likely coming out of this cycle, our labor force participation rate will be even lower than it was before. And this has implications. And the point is that after the financial crisis, prior to the financial crisis, up to 2007, the long-term linear growth trend of the economy ran at about 3.2%. Going back to 1947, on an inflation-adjusted basis. So the economy was growing every year at roughly about 3.2%, inflation-adjusted, since 1947. That's a linear trend. Some years were more, some years were less, but the linear trend, about 3.2%. After the financial crisis, that linear trend dropped to 2.2%. We clipped a full percentage point off of the long-term linear growth trend because of the increase in the debts and the deficits and what happened with the financial crisis. We never recovered back to the long-term linear growth trend prior to the financial crisis. Now, the problem with this analysis is that if you listen to the media said, oh, the economy recovered back to where it was pre-financial crisis. Yeah, like in 2017, 2018. Now, all that says is that we were a $20 trillion economy in 2008. And then in 2014, 15, 16, we got back to a $20 trillion economy. Now, you didn't grow during that entire period, right? All you did was get back to where you were. But what's important is what is the linear trend of that? What is the growth trend of the economy? Because that's what drives economic expansion and drives profitability for corporations, et cetera. Well, that was 2.2%, a full percentage point less than what we had prior to the financial crisis. Interestingly enough, that was exactly what Reinhart and Rogoff wrote about in their book called This Time is Different. They said that when countries exceed 100% of debt to GDP, the growth rate tends to drop by 1%. Exactly what happened. Now everybody snuffled that off and said, they're crazy. That's not working. Look, we're growing at 2%. Yeah, we used to grow at 4, actually, at the beginning of the century. We used to grow at 8. Prior to the 80s. I mean, the growth rate has been declining every year very slowly because of the debts and the deficits. So here we are. We've ramped up a massive amount of debt and deficit over the course of this year. And, of course, with the new administration coming in, they have a big spending plan built into place that will require more debt, because we're not creating the revenue to pay for it, right? So this is going to ensure basically a economic recovery that is less than what we had previously. So if we were at 3.2% originally, 2.2% after the financial crisis, we're going to be somewhere around 1.5 to 1 3/4 on the linear growth trend after recovery because of the debts and deficits. Now, the reason I tell you this is because the economy is where corporate profits and earnings come from. So the market has a lot of problems ahead of it. Now, there's a lot of hope here about we're finally going to see the rotation from growth stocks back to value stocks. There may be a very short rotation into value stocks, just because the market's looking to buy stuff that's not run up as much as everything else, right? So today's trade, because of another vaccine issue, is going to be sell the stay-at-home stocks, buy, energy and industrials and those type of things. The problem is a lot of those companies are already very overvalued. They're not really value stocks. But more importantly, those companies in particular depend upon stronger economic growth for their profitability. I mean,
If you're an industrial, a basic material, an energy company, you require economic activity. That is where your earnings come from. People need to be building stuff. They need to be building roads and bridges and buildings and doing things that require materials and industrial products to build, right? We got to be building stuff. Well, CapEx, as a function of the economy, has plunged. And not just post-pandemic. We've had declines in CapEx spending now for the last several years, as companies are spending less and less money on capital expenditures, spending more and more of their money on stock buybacks and dividend issuance, taking on more debt to do it. Coming out of this, even if we get a vaccine and we do get a recovery, odds are we're not even going to get back to the rate of growth we were previous to the pandemic, which is going to be more problematic for the long-term growth and earnings potential for materials, industrials, and energy companies, which require economic activity to a large degree to boost the demand for their products, services, and create their revenue. Financials, as I said at the open, they need higher interest rates. They need to be able to loan money at higher interest rates, which is where their money comes from. The problem is if you get higher rates to any real degree, and heaven forbid the Fed actually raise interest rates, well, the economy with $75 trillion worth of debt doesn't respond well to higher rates. Housing markets, debt, credit cards, all those things, everything that we do and consume on debt becomes a pincushion with higher rates. Quick break. We'll come back. More of the Real Investment Show. I'm Real Lance Roberts. RealInvestmentAdvice.com. Our latest article is up, The Buffett Indicator, Why Investors Are Walking Into a Trap. It's on the website now, RealInvestmentAdvice.com. Be right back.
Listen anyplace, anytime at realinvestmentadvice.com.
Long-term care is the financial elephant in the room. The median national cost of a private room in a nursing home? $8,517 a month. Are your finances prepared to handle that burden? Our next Candid Coffee with Richard Rosso and Danny Ratliff can show you how to protect your finances from the effects of a long-term care event, the myths to ignore, and how to prepare a plan to address the cost. Register for the special long-term care edition of Candid Coffee, Saturday, December 5th at riaadvisors.com.
Got questions for Lance later? Ask now at realinvestmentadvice.com.
Welcome back to the show this morning. I'm Real Lance Roberts. And getting into this Monday, the week before Thanksgiving, by the way.
Where has the year gone?
I know. It's just, and honestly, after this year, I'm completely fine with it.
Yeah.
But unfortunately, I've been saying that for the last couple of years. It's like, this has been a tough year. Maybe next year will be better. This year, pretty much any year after this year can be better. That's the good thing about 2020. Once we get past the tornadoes, the hurricanes, the flooding, the elections, and the viruses, next year's got to be better. I mean, you pretty much can't.
Yeah, don't ask.
I know, right? Gotta hope. Next year, you can come out of your cave and see your loved ones. That's the goal for 2021. It's interesting. We talk a little bit about the economy, and we talk about how things have changed, right? People are doing things differently. Well, yesterday, I got a haircut.
Nice.
Got a haircut yesterday. But see, this is one of the changes, and this is something my family will probably never change back. We have developed a relationship over the course of this virus. We developed a relationship with a hairstylist that my wife has used for years. She now comes to our house. The whole family shows up. Everybody got a haircut yesterday. It was 6 hours of haircuts and styling in our living room yesterday.
Even the dogs?
No, they don't do the dogs, stupid. They were vacated. But
It costs more to do my dog than it does to do my wife's hair.
well, that's your problem because
I'm just saying.
you just grab a clipper and go, and you can do a dog pretty cheap.
Well, we make up the difference on me because that's what we do.
Exactly. So, but anyway, yeah, it was 6, 7, 8 hours yesterday of blowouts and curls and
That's pretty cool, though.
hair dyeing and great for her, right? She comes to our house, she hangs out all day. My wife calls it hen talk. And so, because all the women get together, they catch up with everything.
Yeah.
The kids get their hair cut first, and then they're off doing their thing. But she makes a lot of money. She has no overhead, right? Because normally, like at the salon, she's got to pay a percentage of her tips and stuff off to the salon, like 50%. It's not cheap. She keeps 100% of the money coming to the house. So for her, this is a really good deal for her. She comes out, she knocks out a Sunday afternoon. Got a babysitter. She's got like 3 kids. So she's got a babysitter for a kid. She comes on, makes twice as much money as she does working all day at the salon. And
uses your product.
And uses our product.
Yeah.
But the interesting thing is that, this is a change to the economy that will not, look, this is an isolated incident. But my point is that if we're doing this, it is likely there's a lot of people doing this. And this is a change to the economy that won't go back. Right? It's convenient for us. It's very convenient. My family has a wonderful time doing this. Everybody sits around, they talk, they drink wine, whatever, and they have a great time catching up while they're all getting their hair done. Or as my wife says, get their hair did. So, but that is something that we will unlikely go back to doing differently in the future. But it was something that developed because of the shutdowns. And the issue with the virus, right? And I'm sure that we're not the only ones doing this. I am sure that there's a lot of people that have changed a behavior or changed a structure that will not return even with the vaccine when we get one. And that has implications to the overall economy. And right now you're thinking, yeah, but she still made money. Okay, yes, she did. But that activity is not going to be captured within the economic data stream, right? So the problem is going to be a couple of things, right? There's going to be an entire new economy that operates now outside of the captured economic data. That will have an implication on future data reports that we have coming in. And it's not, I don't want to call it a black market economy, but it's effectively that. I mean, you hear about these black market economies. Well, these black market economies that work on barter, buy or sell, they operate outside of your normal economic data collection, so they don't get that activity, right? It's not included. And there's an entire process within the economy of people now working outside of the actual economic data. Again, when you and we were talking about the employment numbers a few minutes ago, right? The labor force participation rate 50% right now. Now, you mean to tell me that out of all the individuals between the ages of 16 and 54, now, by the way, when I'm talking about the labor force participation rate as such, I exclude everybody over the age of 55 to get rid of that whole argument, well, boomers are retiring. When you have 50% of your 16 to 54-year-old population working, you got a problem economically. But again, a lot of those people are working. They're just working outside of the official labor force statistics. Right? And so this is something that won't change. So we're going to see some interesting developments come along. But again, this is a small portion of the overall economy, right? But it is something that is going to be a change. Just like when individuals came out of the Great Depression, I'm not saying we're in a depression, but when individuals came out of the Great Depression and banks had failed and people had lost all their money in the banks, because when the banks failed, they lost their money, right? There was no FDIC insurance. The bank failed. It went bankrupt. If you had money in the bank, you were done. So coming out of that, people that had lost money with the bank failure said, I'm never putting my money in a bank again, right? There's, ask your grandparents that lived through that. I mean, I knew a lot of elderly people that literally had jars of money in their house, because they didn't trust the banks. And that was okay, but it was a change of behavior. That experience changed their behavior going forward. This experience coming out of this pandemic is going to change behaviors. It's interesting. Prior to the pandemic, Chinese have been wearing masks forever, right? Every time you see Chinese, pictures of China, blah, 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 they're all running around wearing masks. They've been wearing masks for a long time. This pandemic didn't start a thing, right? In the U.S., we would look at that previously and go, why are they all running around wearing masks? Well, because they had SARS, they had, the avian bird flu, they had all these other things. So that's why they started wearing masks early. We would look at that and go, why are they all running around wearing masks? Well, now we know. And now wearing masks is a thing. So we've changed behavior. We've changed people's activities, right? People have reduced their activities. And even with a vaccine. And let's talk about these vaccines here real quick. Pfizer says their vaccine is about 90% effective. Moderna says, ours is 94.5% effective. Reality is that both of these vaccines will likely be about 50% effective. A couple of reasons for that ultimately is that the virus is going to mutate. Once you have a vaccine, the virus will mutate. Just like the flu does, right? There's 150, don't quote me on the number, but there's 150 different variations of the flu. When you go get a flu shot, it treats 5 of the most common. So if you get one of the variations outside of that, guess what? You still get the flu. It happens. So while the vaccine will certainly reduce the number of people getting sick from COVID, it's not going to eliminate it because it will mutate. And so even when we get a vaccine, people are still going to be susceptible to the flu. They're going to be susceptible to now COVID. Now we've got the winter flu season, right? We got the COVID flu season every year going forward. That's going to change economic behaviors. We're going to potentially do less, right? Stay home more, socially isolate, blah, blah, blah. So that's going to have economic impact. So when we take a look at what we're paying for stock prices and valuations relative to economic growth, that's going to be problematic. Will airline travel return back to where it was pre-pandemic anytime soon? Probably not. It's going to be a while. But there's a trade there. Again, don't get me wrong. What we're talking about is long-term recovery, valuations, et cetera, versus short-term trading. Now, again, airline stocks are going to be up real strong today because of the vaccine news, right? So, great, we got a vaccine. People can go out and start flying again. Well, they're not tomorrow. Maybe sometime late next year, they'll all get on an airplane. That's a long time to go. And a lot of these airlines are hemorrhaging cash. We're about to see more airlines do more layoffs. We're seeing energy companies do layoffs. We're going to see more and more companies do layoffs. The vaccine news is excellent. Don't get me wrong. But it's going to take time. So chasing markets here that are already overvalued, extended, deviated from long-term means, et cetera, likely is not going to work out as well as being patient. Let some of this stuff occur. The market's going to pull back. You're going to have a better opportunity to put money to work, in the next couple of months, right? And again, you've had plenty of opportunities this year, right? You had the correction in September. You had a 10% correction in September. You had a 10% correction in October. You had a 35% decline in March. This has been a great year. If you're a trader, this has been a great year for trading stocks. Long-term investors, it's been a little bit more of a challenge because the market's just been very volatile. That's not likely to end anytime soon. And part of our article, it's on the website now, about the market cap to GDP is that what we're paying relative to what the economy can generate is grossly deviated. And eventually, corporate profits and earnings matter, and they matter a lot relative to what you're paying for investment. Quick break. Be right back on The Real Investment Show. Don't go away.
You're listening to The Real Investment Show.
Long-term care is the financial elephant in the room. The median national cost of a private room in a nursing home? $8,517 a month. Are your finances prepared to handle that burden? Our next Candid Coffee with Richard Rosso and Danny Ratliff can show you how to protect your finances from the effects of a long-term care event, the myths to ignore, and how to prepare a plan to address the cost. Register for the special long-term care edition of Candid Coffee, Saturday, December 5th at riaadvisors.com.
Life is a series of events. How long will your retirement last? More importantly, how long will your retirement funds last? You can plan for a successful retirement with RIA Advisors' free financial planning tool, MyBlocks. It's our online modular manager for your money and your life. Does your vision of retirement match up to reality? MyBlocks can help to determine how much you'll need and how to achieve that goal. Create your own personal financial vision for the next decade with MyBlocks, our free tool at riaadvisors.com. That's riaadvisors.com.
The Real Investment Show.
Carry on my wayward son. There'll be peace when you are done. Lay your weary head to rest. Don't you cry no more. Yo!
And welcome back to the show this morning. All right, get ready to wrap up this Monday edition of the Vaccine News Mondays. Last Monday, Pfizer. Today, Moderna. Who's next week? Who's coming up for next week? We will have to figure that out yet. Next Monday will be the next virus. AstraZeneca, maybe.
Yeah.
I don't know. We'll see.
Yeah.
We'll see. Whoever's next coming up on the list.
Lily.
Maybe. I don't know. It'll be another one. The timing of the news is awful interesting.
Oh, yeah.
Yeah. So, but that's another thing. All right. Anyway. So, as we get into, the holiday shopping season, it's now, going to come down to really this idea of economic strength, right? Because as we move into Thanksgiving, we've got a lot of we have a lot of health experts canceling Thanksgiving and Christmas. I don't know about you, but you're not canceling Thanksgiving and Christmas at my wife's house. Ain't happening. Saturday was Christmas tree decorating. So the Christmas tree is now, one of the Christmas trees is now officially out, up, and decorated. The girls and my wife spent Saturday evening decorating a Christmas tree. But never forget, we had a major crisis this weekend at the house.
Oh?
Yeah, we had that cold front come in.
Yeah.
Right?
Yeah.
And so my wife has these big inflatable turkeys in our front yard. and which is funny because we have these big inflatable turkeys. Well, our next door neighbor, they have their baby was a bit premature, right? And has some, weaknesses immune-wise because it was premature. So they've been locked into their house. Really very concerned about COVID, as they should be. So Halloween came around, and nobody was going out trick or treating, and they have a young 5-year-old son, super cute kid, right? So, but couldn't go out trick or treating, but he was dressed up as Spider-Man. That was his Halloween outfit. So, a good friend of mine, Spider-Man, showed up to his house to take trick or treat to him.
Wow!
Right, and so. He's now bonded. He knows that, I'm good friends with Spider-Man.
Yeah.
And, and so now he has this propensity to come out and tackle the turkey in our front yard. So that's been a bit of a challenge. But on Sunday, right? Or so was it Sunday?
Yeah.
That
blew through on Sunday.
So when the thing blew in, all I heard my wife was screaming. She's like, "Emergency, turkey down!" Because the turkey was face down in the front yard because it had blown over. So we had turkey down on Sunday. You had to fix that problem. But, Thanksgiving's coming up, right? Christmas trees are coming out. everybody's making plans now to how to socially and consciously, gather at the house for Thanksgiving. Everybody's figuring this out, right? But everybody's gonna get together for Thanksgiving. Yeah. We're just gonna do it carefully because we have a lot of elderly people in our family, namely me. So, we're being conscious about it, but you're not going to stop that from happening, right? You can try to cancel Thanksgiving. You ain't canceling Thanksgiving. Sorry. You're not going to cancel Christmas. But it's interesting because if you take a look at spending patterns, credit card spending has begun to slow down again. The economic recovery that we saw picking up from the lows because of all the stimulus that was put into the market is now fading off, right? Because, we're running out of stimulus. And the stimulus is fading. And come January, if we don't have more stimulus, an extension of the moratoriums, a lot of the rent abatements and a lot of the moratoriums on mortgage delinquencies are going to evaporate. And there's going to be a lot of problems in those areas. But importantly, as we start going into the holiday shopping season, this is functionally the time of the year that retailers go black. And if you're looking at a lot of the real-time credit card data, it's actually been rolling over here lately. In other words, it's slowing down. People are spending less. And of course, that makes sense, right? The excess money they had coming in earlier this year that they were getting the extra $600 a week on, unemployment benefits, etc. They spent it already. And this is an important point that, has wide-ranging effects across the economy. And so when I was talking about a moment ago is that, yes, we're going to get a vaccine, and yes, things are going to start to return back to somewhat of normalcy. But there's a problem that the vaccine doesn't cure. And one of the primary reasons that we're not going to get back to the economic growth rate we were previously, and that's because when you gave all this money to individuals earlier this year with the shutdown of the economy, they went and bought a bunch of stuff that they wouldn't have bought otherwise because they actually had more money now than they normally had, right? So whatever budgeting process they were on, that went out the window, and they said, hey, man, we got an extra $600 a week coming in. Let's go buy a new car. And that's what they did. And so we saw auto sales jump. We saw used car sale prices jump up because people had this extra money they didn't have before. And they did what they do. They went and spent it all. Here's the problem. And this is one of the big problems for the economic recovery, even with the vaccine, is that you've now done this. This is what we call pull forward consumption. Let me ask you a question. There's something in your life that you want a lot, right? Big screen TV, new car, whatever it is. But you don't have the money for it right now. You're going to, you're saving up for it, or, your budget's kind of fixed at the moment. You're going, well, I can wait on that, right? We'll get the TV next year, or we'll buy the new car next year. This is how, most people plan stuff, right? It's like, hey, I really want this. I want to go on a trip. All right, we'll save for it and we'll go, 6 months from now. And I go, okay, here's a check. Well, instead of waiting for 6 months or a year or however long you were going to wait and plan and save for this purchase, you now do it today. So you've now pulled forward that future consumption. So whatever was going to happen in the future has now already happened. And people have spent all that money. So even if we get an economic, recovery in terms of a vaccine, the growth rate will be slower because what we've done is we've pulled forward all this future consumption to today. And if we have a vaccine, and here's the problem for the Fed and for the government. If you have a vaccine, it's going to be really hard to pass big stimulus programs because you have a vaccine. The economy's recovering. Everything's fine. Everybody's going back to work, right? So all of a sudden, it makes it much more difficult to go past a $2 trillion or a $3 trillion stimulus package. Maybe you get a little something, but you're not going to get this $2 or $3 trillion package. The problem with that is that the Federal Reserve needs more debt in order to do their monetary interventions, QE, because that's what they do is they monetize the debt and the deficit to provide more liquidity through loans to the economy. But since people have already borrowed money, spent money, etc., the demand for loans has actually been declining sharply. If you take a look at the Federal Reserve's emergency lending programs, I put a chart out on this morning. PPP, Main Street lending programs, all these programs that the government put together to bail out the economy have not had a lot of uptake. Most of them are about 50% uptake at most. Some of them a lot less. So there's less and less impact from what the Fed does in terms of their monetary interventions. A vaccine reduces the need for stimulus, and you've already pulled forward all this future consumption. So the point about all this is that, yes, you're going to get economic growth. A vaccine will certainly encourage people to get back out into the economy and go back to work. But now there's this huge void economically of all the consumption we pull forward that has to be filled. And that's going to take some time. And what that will lead up to is lower rates of economic growth. So again, this goes back to our article that's on our website today. It's basically talking about market capitalization to GDP. And there's a big disconnect. Right now, market capitalization is trading at the highest level ever in history relative to the economy. And a lot of people dismiss that, and they say the common meme is, well, stock market's not the economy. True, it's not. But stocks generate their revenues, what happens at the top line, their sales, from economic activity. In other words, if Apple doesn't sell any iPhones, they have no revenue. So it's really hard to produce earnings growth if you're not selling any iPhones, as an example. I mean, let's be extreme about this for a moment. Apple iPhones go to zero. How profitable is the company in the next quarter? Not. Those revenues, those iPhone sales come from people in the economy. They got to be out there buying stuff, consuming stuff. That's where those revenues come from. So while the stock market can detach from the economy in the short term, in the long term, corporate profits and ultimately earnings and revenue all come from economic activity. So that deviation cannot last indefinitely. That article's on our website now explaining the whole thing. It's on the website now, realinvestmentadvice.com. That's where you'll find all of our articles. And our latest newsletter is out as well, talking about the markets, where they are right now, and why the current extensions are a bit dangerous here, and maybe start thinking about taking some profits and reducing risk. That's all on the website now, realinvestmentadvice.com, along with our latest blogs, podcasts, videos. Everything is there. Send your questions, comments as well, realinvestmentadvice.com. We'll see you tomorrow.
Get daily investment news you can use, delivered at the speed of the internet. Sign up for the Real Investment Report now at realinvestmentadvice.com.
It's a rich man's world.